Morning everyone, welcome to Ainsley News. For some of you, welcome to the new year. It's Friday the 7th of January. Today we're talking about a must-read or must-listen, the gold and the changing world order. It's a bit longer today. Grab a cup of coffee if you need to, but it'll really help you understand the big picture. This is a bit of a macro of macro. Back in 2020, we discussed Ray Dalio's take on the rise and fall of empires and the long-term debt cycles that go with it. So as not to repeat too much today, they are both very much worth listening to or reading. With some links in our news today. You can go back and read those articles back from 2020. From those that don't know him, Ray Dalio is the founder and CIO of the largest or world's largest hedge fund, Bridgewater. Today's a summary of his articles published on LinkedIn this week. If you want to read the long version, we recommend you do. Check out the link here, we'll include in the news today. Directly to that LinkedIn article. Those article links are in ainsleybullionn.com.au and click on news. Right, let's start with his conclusion up front and then look at some key charts. A bit tricky to look at those key charts as well via audio today, so definitely jump over to Ainsley Bullion's news and I'll talk you through it and you can look at those charts in that order. The world order is not or is changing in important ways that have happened many times before in history, though not in our lifetimes. How the world order is changing has created the paradigm that we're in. By paradigm, I mean the environment that we're in. Paradigms typically last about 10 years, with occasional big corrections within them. They're driven by a persistent set of conditions that takes those conditions in a swing from one extreme to an opposite extreme. Because of this, each paradigm is more likely to be opposite than similar to the one before it. For example, the Roaring Twenties were followed by the Depressionary 1930s, and the inflationary 1970s were followed by the disinflationary 1980s. The assets and liabilities that you would most like to have and those that you would most like to avoid change with the paradigm that exists at the time. For example, in the Roaring Twenties, you'd want to own stocks and avoid bonds, while in the Depressionary 1930s, it would be the opposite. In the inflationary 1970s, you'd want to own hard assets like gold and avoid bonds, while in the disinflationary 1980s, you'd want to own financial assets and avoid hard assets. For reasons explained in this report, I believe the current paradigm is a classic one that is characterized by the leading empire, the US, spending a lot more money than it is earning, and printing and taxing a lot. 2, having large wealth values and political gaps that are leading to significant internal conflict. And 3, being in a decline relative to an emerging great power, China. The last time we saw this confluence of events was in 1930 to 1945. Though the 1970s-1980 period was also analogous financially. In this piece, I'll explain my reasoning and show charts that display these things happening. For a much more comprehensive description, read Principles for Dealing with the Changing World Order. What should one do with this new paradigm? This paradigm is leading to a big shift in wealth and power. Naturally, as a global macroeconomic investor, the economic and market behaviours in this paradigm are top of mind. I think one should consider minimizing one's ownership of cash and bonds in dollars, euros and yen, and or borrow in these, and putting funds into a highly diversified portfolio of assets, including stocks and inflation hedge assets, especially in countries with healthy finances and well-educated and civil populations that have internal order. These things are especially important in this paradigm. In brief, I think one's assets and liabilities should be well balanced with minimal exposure to dollar, euro, yen currency and debt assets. During this time, I also think it will pay to be short cash, i.e. borrow cash. Of course, there will be corrections during the several years in the paradigm. For example, central bank tightenings, but I don't see any sustained period in which the government will likely allow cash returns to be better than the returns of a well-diversified non-cash portfolio or an all-weather portfolio, geared to the level of risk you're comfortable with, because that would cause terrible problems. These circumstances also have big geopolitical implications, which we'll also touch on. Dalio then goes on to address 3 key issues that evolve from this. 1, big debt and debt monetizations, particularly in the world's leading reserve currency. 2, internal conflicts over wealth and value gaps. 3, external conflicts, most importantly the rise of a great power, China, to challenge the existing great power, the US. To summarise each, big debt and debt monetizations. The chart we're going to show you here for the US shows how debt levels are high today and were high in the 1929 to 1933 and 2008 periods. In both cases, interest rates hit 0%, and the printing of money and buying of financial assets began in a big way. COVID has seen that exacerbated and likely to continue with global political move to the left. This makes everyone financially rich, i.e. they have a lot of money, and it devalues money, which takes away much of this newfound wealth. This chart's showing that here. Dalio then goes on to graphically show what should already be very apparent to most, and that is cash and bonds are stupid to own, given you are currently getting the worst interest rates ever in both inflation-adjusted and nominal terms. The chart's reflecting that. At the time when the Fed is tapering QE and being forced to look at raising rates on surging inflation, Dalio reminds us that remember that one person's debts are another man's assets, and imagine what would happen if the asset holders sold because the debt assets were unattractive, which they are. That would lead to either a big increase in interest rates or a huge increase in the printing of money to buy the debt to artificially hold interest rates down. Next chart we're going to show you shows the amount of debt assets relative to GDP, which means that a lot can be sold if the holders lose their taste for it. And here's the crunch for precious metal investors. The amount of financial assets relative to real assets is dangerously high, which could lead to a bank run type move from financial assets to real assets. There's only one purpose of investment assets, and that is to sell them to get cash to buy the real goods and services that one wants. Throughout history, whenever there were far more claims on real assets than there were on real assets, a crisis eventually occurred when many holders of these financial assets went to sell them and discovered that there were far too many of them. That led to a run on the bank type dynamic. Right now, there are vastly more financial assets than there are real assets. So if there was a move to convert them into real assets, that would lead to a run on the bank type of dynamic, which central banks would certainly respond to by printing a lot of money to allow people to get the money, but it would be at much less value. Making financial asset prices go up by creating a lot of money and debt makes people financially richer, but it doesn't actually make them really richer. It also leads to periods of bad real returns. This is shown in these next few charts. The top chart shows financial assets values as a percentage of all assets. The second chart shows financial net worth relative to GDP. And the third chart shows rolling returns of the 60-40 stock bond portfolio since 1910. Internal conflicts over wealth and value gaps. Again, not new to regular listeners and readers, covered by Dalio extensively previously. Fundamentally, the fiscal response by central banks has seen an incredible explosion of wealth for the rich, but left the rest behind, so that the gap is now the largest since the 1930s. Social implications of many, and Dalio in the previous links, has talked at length of the historic paradigm shifts such deep-seated social dislocation fuels. In this piece, he presents the growing political divide occurring in the US, greater than at any time since the 1900s. So the gap between them is enormous. There is great internal conflict going on in the United States now, which makes it a risky place. 3. External conflicts due to the rises and declines of great powers. Again, covered previously in the links to our previous articles, Dalio believes we are witnessing the transition of a dominant empire. The chart we show you here simplifies the version of what you just saw of these 4 empires. The grey shaded areas are the periods of great internal and external conflicts and restructurings via depression, revolution, and war, typically lasting 10 to 25 years. They are followed by more extended periods of peace and prosperity in which order is brought about by the existence of a dominant power that no country wants to fight because it's too strong, leading people to work harmoniously together for a period. Some beautiful charts here showing the end and the beginning of the new, from Dutch to British, and other cycles there. Or in other words, after revolutions and wars, a new order, i.e. a new system run by new leaders, is created. For example, the last world order to be created came after World War II in 1945. At that point in the cycle, there is a dominant power, and nobody wants to fight the dominant power, so this is part of the cycle, is typically peaceful, and if managed well, prosperous. It is economically rewarding, which leads people to borrow and bet on it continuing, leading to over-indebtedness. Because economic opportunities are naturally distributed unevenly, large wealth gaps develop. Also, with time, competitors emerge and grow in power. Over-indebtedness and declining competitiveness eventually lead to financial problems at the same time as there are large wealth and political gaps. This produces more internal conflict and people demanding more money, which leads governments to create more debt and print a lot more money, which weakens the currency and raises inflation. As the dominant power weakens and other powers get strong enough to challenge it, there are greater internal and external conflicts that lead to revolutionary changes in who has what wealth and what power. That ends the old order and leads to the new order. And that is now happening. From an investor point of view, his key takeaway is, I believe that important wealth and power shifts are underway, creating a new paradigm in which, one, it is undesirable to hold dollar, euro, and yen-denominated credit assets, especially short-term debt assets, cash and bonds, because they will have significantly negative real returns. And two, it is desirable to hold a well-diversified portfolio of currencies, countries, and asset classes. We constantly preach balance and diversification, and at a very fundamental, very compelling, obvious level, Dalio highlights overtly the importance of real hard assets in that mix. We often talk about what happens when the $300 trillion worth of financial assets tries to get into the $1.5 trillion investable gold space. Gold supply cannot be expanded, and so when that demand hits that finite supply, that only leaves price to change, and that's generally upwards. Thanks for listening to today's big news. And again, welcome back. Thanks for joining us. Remember, ainsleyBullion.com.au for all things physical. Jump over there by gold, silver, and platinum. Also read and view all our news. ainsleywealth.com.au for all things cryptocurrency. You can buy direct from Ainsley. Have it sent directly to your existing wallet. Or we can create a new wallet for you. We can also securely store all of your crypto purchases for peace of mind. And if you haven't checked it out, check out goldsilverstandard.com. That's our own crypto that we've built. And it's also backed by real gold and real silver. Enjoy your Friday, everyone, and weekend. And we'll catch you on Monday for more news.